Good afternoon, everyone. This is Rob Barnett from Bloomberg Intelligence, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. We have a very special guest today, Josh Young. He's the Chief Investment Officer of Bison Interest. He's based in Houston, Texas. He's super active on Twitter and the OOTT hashtag. I think he's got a very provocative view on the market, which is why we asked him to join us here today. Just a quick rundown. Brent's around $120 a barrel. Henry Hub's closer to $7 per MMBTU, while European gas is over $30 per MMBTU again. Josh, what do you make of the market in general, and where do you see oil going in 2H?
So the broader market, I honestly don't know. In terms of the oil market, it looks very undersupplied. And so I think there's just a question of how much does the economy slow down, and how much can production ramp up as companies start drilling again and trying to ramp up production.
Yeah, I was just saw earlier today, IEA was speculating that 2023 is going to be a tight market as well. In the oil market, there's often a lot of talk about cycles, super cycles. When you think about oil above 120, is this an enduring trend, or certainly something that could last in a multi-year way, or are you starting to have some concerns on the demand side that could start to cool the market?
These are great questions. I think wide refining margins with oil at current prices indicate that the market can tolerate even higher oil prices, especially as refining margins start to cool off, likely at some point in Q3, Q4. So I think we're seeing evidence that the consumer can support, to some extent, oil closer to $200 a barrel than $120 a barrel. And then I think it's not about like what's comfortable, it's about where does the market clear. And it seems like the market clears at a higher price, or at the very least that it takes a while to get new supply on to the point where it forces price down from here.
Speaking of supply, I'm very curious to hear, particularly given where you sit, what your expectations are from the U.S. shale patch. Are you anticipating a big ramp up in supply given the price environment, or has the market generally changed? I would note just yesterday we saw Harold Hamm from Continental Resources. Part of the rationale for him wanting to take the company private is that I think he can be more focused on new supply rather than capital returns. So, where's U.S. shale in the global supply mix right now?
Yeah, so I had dinner with a private company CEO last night in the Permian, and here in Houston, but his company's in the Permian, and we talked about kind of what their current situation is and what it would take to bring on an additional rig. And there's a lot more complexity than just high price in terms of bringing on additional equipment. And given how tight existing capacity is and how strained his company's supply chain is and his service provider supply chains are, his concerns aren't just around, hey, I'd have to pay another $10,000 a day rig rate for a new rig. It's also how much time is it going to take to ramp up that crew? How reliable is that going to be? And what's that going to do to my performance metrics? What are my new wells going to look like? And so I think there's a lot of considerations beyond just the pure, hey, oil's high or gas is high, therefore I'll drill more. And I think it's not just him. I think that's from an industry perspective. And then specifically for Continental, my take on that is Harold Hamm has basically done whatever he's wanted as the majority owner and CEO of the company. And so I don't read this. It seems more likely to be related to other considerations. I think if he wanted to drill more, he'd just drill more within Continental. And if shareholders didn't like it, he could do a share buyback or some other sort of thing without having to necessarily take it private. So I don't buy that explanation. I think there's something else going on.
Okay, very interesting. One more question, and then we'll sort of bring on the team here. But there are a lot of geopolitical factors, arguably, in the market right now. Whether you're looking at Russia, Libya, other areas where there are supply concerns. What's the geopolitical risk premium that's evident in the market, and do you see any potential easing there?
Yeah, I think there's risks and premiums kind of in both directions. So obviously there's some Russian production off, although it looks like from the May numbers, Russian production rebounded to some extent. Libyan production's off, but it could just as easily be fully on. It's kind of one of those news items that awkward to talk about because it's probably wrong by the next day or by the time people see it. But I think on the same token, the world economy is quite weak, and there are lots of challenges and issues for consumers that are unlikely to be persistent in the long run. And so when you think about sort of short-term risks, I think there's the short-term risk around, hey, what happens if more Russian production comes on? What happens if more Libyan production comes on? But then also, what happens when the consumer is stronger again? What happens when China starts growing their economy again or fully reopens and so on? So I think there's a balance. I think there are definitely short-term risks and short-term potential upsides, as well as sort of looking out into other timeframes.
Okay, Salih, I want to bring you on to sort of get your general reaction. I think you guys are kindred spirits somewhat here, but what's your read on the IEA's latest outlook and supply-demand balance? Are we going to be continued undersupplied or tight market as you look out into 2023 as well?
So yes, I generally very much agree with Josh's angle on the oil market. And what we saw this morning from the IEA report was actually a lot of warnings. I mean, a lot of the things that we've been talking about on these calls, but this is actually the first time IEA actually doesn't only talk about 2022, but talks about the next year as well. And what they're essentially saying is that this kind of difficult, tight, and potentially undersupplied market is likely to roll over to next year. And they're really kind of giving the warning that supply increase may continue to struggle with increased demand. I mean, they do mention the potential downside of the slowdown in global economies. But at the same time, they still see Chinese oil demand growing by another 1 million barrels per day next year, total global oil demand growing more than 2 million barrels per day next year. And if you look at the next few months, I mean, we already see a very tight market, but we kind of get a little bit of comfort by seeing that spare capacity that OPEC is sitting on. But when we say OPEC, it's really just Saudi Arabia and the UAE. But then come November, December, and when we're really looking into next year and when we don't see much supply growth coming from elsewhere, then we're sitting in a position where demand is still growing. There is still this demand outlook for the following 12 months that's looking pretty good. But then supply isn't growing enough, and at that time, we may have literally run out of spare capacity. So even though the market may technically be balanced at the time, then we don't have any cushion in the market against any further unexpected supply disruptions. And I think historically, and you don't even have to look back that much, just look at Libya now. We know in the oil market unexpected things happen. And that's why having this type of spare capacity is important. That's why having relatively high inventories for crude and for products is very important. And when we don't have that, this can be extremely bullish for oil prices as well, even though the market is technically balanced, because then the market can get very anxious, and we can then get a panic-driven rally. So I think looking at everything that's going on, I think it's just very difficult not to be nervous, and I think this is exactly the feeling that I got from the IEA report this morning.
Josh, one of the ideas that we regularly talk about here on this call is the idea that the industry has been underinvesting in new supply. And this isn't just a very near-term phenomena. I would argue that it was happening prior to the pandemic and things like that. Would you sort of generally concur with that view? And in turn, does industry need to ramp up spending more?
So I think there's been a long-term underspend on exploration and development on long lead projects, while at the same time there was a enormous capital destructive shale boom and bust set of bubbles or a set of booms and busts. And so I don't think that the industry should go and do what they did again from 2012 to 2018, where they drilled unsustainably low return wells just for the sake of volume growth. I think that would be a huge mistake, and I think that's bad for the industry, and it would be bad for the consumer because it would also be unsustainable. So I think there should be a lot more spend on exploration for larger fields. We only, I think, discovered 10% of the oil that we produced this last year, something like that. So I think there's this sort of bigger, and that's where, you mentioned I have a controversial view. My controversial view is that we can have this multi-year bull market. I've had that view since it was deeply unpopular. We started Bison in the middle of this sort of shale bust in 2015. And it's taken a while for it to start to play out, but there's this big undersupply issue. It's an issue at OPEC, it's an issue at NOPEC, and it's an issue U.S. and Canada and elsewhere. And so, I think there is this real potential. There is one thing which concerns me, which is the IEA has been so wrong persistently that them getting bullish for 23 is actually, to me, somewhat of a contrary indicator. And I would start to worry about a potential short-term pullback. If they're worried, I'm less worried. Just they've been so wrong on this for so many years.
Yeah, okay. Very interesting perspective there. Will Hares, I want to bring you on. Will covers the European oil majors. I think there's a really big divergence in strategy and types of capital allocation that are occurring here in Europe versus the oil patch in North America. And Will, you've got a very interesting react on BP out this morning. So why don't you tell us about what they've done and what your take is and kind of how it fits in with this overall narrative.
Sure. Thanks, Rob. So out this morning, BP had a big announcement on, we think it's their largest ever acquisition for a transition business this morning. It's for the Asian Renewable Energy Hub project development. And this is a proposed very large scale solar and wind power development with a potential longer term green hydrogen production component to it. It's got a big capital build out cost of 36 billion gross. And I think this is just another big signpost in what you were saying, Rob, that we're seeing this enormous now unprecedented strategic divergence between the European majors and the American majors. We're seeing more and more of these really large-scale green deals as the Europeans are feeling increasing pressure from a very different institutional holder base, ESG pressure, increased climate scrutiny at the AGMs, which we just saw a couple months ago. And as a result, these companies are adjusting their portfolios very quickly. Both BP and Shell have reached peak oil and gas production already. The rest of the European majors are going to hit peak oil and gas production around mid-decade, give or take, while ramping their renewable capacity. Now, of course, I'm sure Josh has some comments on this as well. But of course, this is a risky play on the transition tipping point, and we've written heavily on that. Renewables are clearly a historically lower return business, but it's a very interesting divergence here that clearly one strategy is going to win out here. We're seeing the Americans doubling down on this oil growth, with their transition strategy largely confined to blue hydrogen production, which is much more complementary to their existing businesses, and to a lesser extent biofuels. But I think it's really just a reflection of the very differing in investor priority bases separating the continents between the pond here. And I think just quickly, we also saw another BP deal earlier this week with BP buying into an offshore project in Newfoundland in Canada in exchange for their 50% interest in the Sunrise Oil Sands project. And I think this goes along with that exact same theme. We're seeing a pullback from non-core businesses from the Europeans, taking advantage of this macro opportunity to divest higher carbon intensity assets, once again in response to that increasing investor pressure. And of course, the key suitors for these kind of transactions, Cenovus, Suncor, Canadian Natural, really remain the only buyers as their portfolios become increasingly consolidated with oil sands, and their institutional holders are heavily weighted to Canada, and as such will be pretty resistant to the same climate ESG activist pressures that the Europeans have faced with their oil sands exposure.
Yeah, great, Josh. I think this would be a very good point for you to weigh in. What do you make of the European focus? Do you think they're taking the eye off the ball? I know it's such a quaint thing for the European oil majors, energy majors as they want to be called now. They're investing in wind, solar, all this stuff. Does that give you extra concern about that longer term supply demand balance if these companies are increasingly investing in other parts of the energy supply chain?
Yeah, I mean, the BP couldn't get oil right, so maybe it's not so bad for them, with the various environmental and other operational disasters that they've had over their not too distant past. I think you could see the share price divergence from, like Will mentioned, the market. People might tell you whatever they want, but in the end, they're in the market for money. And if you're intentionally investing in lower return projects, it hurts your valuation. And so if institutional investors in Europe, along with the boards and management of these companies, decide they want to sort of commit collective suicide from an economic perspective, the market will respond to that. And it has, and it did even last year. Like I think I wrote something on it a while ago where I think it came out a year ago when oil was at 50 or 55, the European majors had massively underperformed Exxon and Chevron, even with Exxon and Chevron having not done so great through the downturn. And, I think it was Chevron that had cut their dividend. I think there were some issues with Exxon in terms of their ability to cover. So yeah, I think the market's responding negatively so far. It's been responding negatively for years now. It's been somewhat oil price insensitive, so it responded negatively even before. So it's not like, oh, they made this bet and now oil prices are higher and therefore it's not playing out. This was a bad bet economically. And I think in the end, investors do want to make money. And if you intentionally make them less money, in the end, they'll either vote with their feet or they'll vote with their actual share votes. And so I think, you saw Dan Loeb get active with Shell, I think on similar sorts of concerns, less getting out of renewables and more just trying to actually earn a profit on that investment. So yeah, I think the market's telling you what's going on, and maybe that will shift, but that would require a really different return profile. And like Will was saying, this big deal by BP, it probably doesn't underwrite a very high return on investment, and that's just going to be hard given their relatively low corporate valuation and them selling a cash cow asset in Canada for pennies on the dollar.
So I want to get your perspective as well on the idea of gas as a bridge fuel. So for some time, I think the oil majors and sort of the oil industry generally kind of said, well, look, we can give the low carbon cousin of oil or coal with natural gas, and that can help be a sort of transition fuel. I think my gut says that the Russia-Ukraine conflict and the really elevated prices over here in Europe maybe are giving people, policymakers in particular, pause on whether that's an appropriate vision or not. But what do you make of the big spread between European and U.S. gas prices, and how do you see that settling out?
Well, so when people talk about the energy transition, they often paper over that we haven't even hit peak coal. So before we can hit peak oil consumption, we have to hit peak coal consumption, and we're still not quite there. We might get to that in a few years, but we might not. There's still coal power plants getting built in India and China. I think that's a tough thing. Obviously, natural gas is way more environmentally friendly than coal. Arguably, it might be more environmentally friendly. It might be more environmentally friendly than solar or wind in some capacities, right? If you put solar in a place where there's not a lot of sun, or you put wind turbines in places where there's not a lot of wind, you can end up with a higher, if you look at the total emissions on building it, installing it, and then eventually removing it versus the power generated by just drilling for natural gas, piping it to where you need it, and then burning it for power. The emissions are actually better on many of these projects just from natural gas, all in, including the methane leaks and everything. And so, yeah, I don't know that I think I have trouble with a number of those aspects. And it's less of a like, hey, I have an economic interest in this, and more just I'm tracking it from a returns perspective and tracking it from an emissions perspective, and just the numbers that are being claimed don't work, and they don't tie.
Patricio, give us a sense on where you see things in the European gas market right now. I think it's probably safe to say that perhaps coal has peaked in Europe, although there's a lot of pressure to bring some of that coal back, at least in the short run, to help manage the broader gas crisis.
I'd echo what you're saying, Rob, that in Europe, coal seems to have peaked, as we've seen. Although we hoped that these elevated gas prices would actually drive fuel switching and power generation in favor of coal, that has somewhat increased, but not nearly as much as historical levels. And I think the other part of demand that it's important to see is that we still have seen a resilient demand for gas, stay resilient. Let's say for the first quarter of 2022, we've seen demand for gas just decline about 5% year over year in the first quarter of this year, and that's mainly driven, there's a mix of factors that may be driving this. First of all, industrial demand. There's studies suggesting that industrial demand in Europe declined nearly 20% in the first quarter, and that has a structural explanation that industrial users are not shielded from the cost pass-through as households or commercial units are. So that explains that. And the other one is that there has been a decrease in household and heating needs for gas, and that has a weather effect explanation. We did have a milder winter, an unusually mild winter in Europe in 2021, 2022. So those are the two things. So it's really hard to pinpoint which are the main factors. Is it weather? But there's certainly evidence that these high prices have destroyed demand, and we see that in that dip in industrial demand. And in terms of supply, if I might just jump into that, there's many things going on with supply at the moment. So we've seen natural gas prices in Europe surge about 22% from Monday until now. And that's mainly driven because we had an outage at Freeport, LNG in the U.S. So just for context, Freeport exports around 20% of the U.S.'s LNG. So it's a massive facility. And running some quick numbers, that means that we're going to lose about 2.1 billion cubic feet a day. And if we annualize that and turn it into BCMs, into meters, into cubic meters, that's around 11 billion cubic meters in a year. So in comparison to European demand in 2021, that's around 3% of European demand that we've just lost automatically for that fire. The outage has been extended. It was initially thought it could be sort of fixed within 6 weeks or so. Now we're talking about 90 days, so we're not going to see that capacity come back online until September. So that's one of the things. LNG has been the savior. That Freedom LNG has saved us from the suppression of Russian gas flows. There's no political intent in that comment, but that is sort of the the outlook, I'd say, for supply. And now on the Russian flow side, we've also seen developments. Yesterday we saw Nord Stream 1 capacity curtailed to only 40% capacity, and that has two reasons, or we're suspicion of two reasons. One of them is Gazprom saying that this is due to sanctions preventing a key piece of equipment coming back from its maintenance in Canada, and they just can't ship it back to Russia. And today we've seen the German finance minister claiming that this move was politically motivated, that no maintenance was programmed until the fall of this year. So there's these two arguments, but I think in essence what this tells us is that Russia does tend to use energy as a weapon, and there may be further risks to the upside for gas prices in the event that we continue to see this level of suppression.
Thank you, Patricio. Josh, we're going to circle back to you in just 1 second here before we have to close out. But Will, I want to get your response on just kind of the gas situation. And there was a question in the chat about Equinor. You had a focus idea on Equinor that you recently closed out, but remind everyone what your thesis was, because I think it ties into kind of the discussion we're having on the gas side of the equation here, and you may want to also comment on the relative performance of Equinor to some of the others in the oil patch.
Yeah, sure. I'll be real quick just to give Josh the last comment. But someone like Equinor, I had a focus idea out early this year, far before the Russian invasion of Ukraine, saying that the European gas market just looked increasingly tight for this year. At that point, we were approaching near record lows for European gas storage. There's a lot of other issues at play, like interconnectors going down, EDF capacity downgrades, and also we were starting to see some suppression of Russian flows at that point, which in hindsight now looks like a pretty interesting leading indicator for the geopolitical developments that were to come. So Equinor is actually the one European exception to the performance question versus Exxon and Chevron. It has significantly outperformed every other global energy major. Now, of course, a lot of this is due to happenstance and geopolitics. Equinor is the second largest gas supplier to Europe after Gazprom, and they are optimizing production, producing every single molecule that they can at the moment, but it's still not going to be enough. And we continue to flag that Equinor is probably among the best hedges to inflation, to geopolitical risk, and sanctions risk, just because of its proximity and positioning as a key European gas producer.
Okay. By the way, for everyone listening, if you pay attention to the chat, Salih has dropped in a survey that we're currently running. We'll be sharing the results of that in the near future. Josh, some of the questions we ask in the survey are pretty interesting. You know, we've got a question on peak oil demand, and we also ask where oil prices could be at the end of the year. So, you know, what do you make of peak oil demand, and where do you see oil prices headed by December? And then we'll probably have to close it out after that.
Yeah, no problem. Yeah, so I don't think we're anywhere close to peak demand. We're seeing, like Patricio was saying about Europe, that even at, I think it's $250 or something per barrel equivalent in Europe for natural gas, we only saw demand down 5% year over year, which is a stunning number that the price could rise that much and only affect demand by that little. So I think you might need to see peak oil demand, at least from a shorter term perspective. You might need to see radically higher prices. And given where OPEC is, I think OPEC is a little closer to running out. And, Saudi Arabia and UAE have a little more capacity, but other countries have actually been seeing their production rolling, excluding Libya. And so I think we could be in a really tight position, especially as travel demand increases and structural demand increases. And then similar to the sort of Equinor thing, I think there's kind of this set of things in the market that are ignored right now. And I'll just say this for a second and let you guys go. I think smaller cap publicly traded producers, there's this weird divergence similar to where, you could buy Equinor 6 months ago for the same price functionally as a BP or a Shell. Right now, you can buy some of these smaller cap producers at, let's say, 2 or 3 times cash flow when, assets are transacting for more than that, and the mid cap and larger cap producers are at 5 or 6 or whatever times. And so I think there's this big dislocation in the market that we're seeing, and that's sort of where I'm spending my time beyond just the macro.
Cool. Salih, over to you for just one quick pitch on the survey and what we're doing there.
And as you said, we occasionally do these surveys, and it's generally very interesting to see the input from our clients. It's very short. I shared the link on the chat as well, and if you're in our distribution list, you may have received an email asking you to take the survey as well. It only takes a minute. I think there are some pretty interesting kind of long-term macro questions in there that you might find interesting as well. So we will close it at the end of next week, and we, always share the results with you as well. So we will be sharing that on the energy chat, on emails, and probably in our next call as well. So thanks in advance for taking participating in it, and we very much look forward to seeing the results.
I think we will be giving away some BI swag to some of the folks who participate as well. So get a coffee mug or an iPhone charger. Yeah. I can't remember what we're giving away.
Yes, so we will have a raffle. Sorry, forgot to mention that. So please do make sure that you put in your email address correctly. And if you win, we will be in touch with you directly, and probably your sales rep will bring that over to you.
Okay, so Josh, it's been a real pleasure to have you on. For everyone listening, Josh is super active on Twitter. Actually, all of us are. So this is a sort of conversation that came about because of the internet. So make sure to follow Josh on Twitter. He's easy to find. He's got a lot of followers, and he's a pretty interesting source for information on the oil market. And we look forward to talking to all of you soon. Shoot us an email or an IB if you have any additional questions. And have a great afternoon, everyone.